This isn't empirical research, it's theory building. And what we did was draw on the theories that we already have, which basically assume that institutions, industries, are interested in self-perpetuation. And instead, what we see is that the financial services industry took on practices that were actually leading it towards, problems rather than survival. So what we saw was a gap in the literature that didn't explain the phenomenon that we saw in terms of the mortgage crisis of 2008. Isomorphism is a phenomenon where organizations, in the case of what we're studying, tend to look more and more alike over time. So they start out looking kind of diverse. There are lots of different kinds of organizations. And then over time, they start to imitate each other. So whether it's the kinds of people that they hire, or the kinds of practices that they use, or the kinds of products that they offer, or the customer bases that they serve, they tend to look more and more like each other over time. It's a very normal process in organizational populations and what we call institutions. And we call this terminal isomorphism because instead of the organizations tending to look more and more like each other in a positive way, they're kind of racing to the bottom in a very special way. And organizations seeking profits from securitizing, making bad mortgages and then securitizing them seems like a good idea for the organization and definitely for the people who are making commissions on those mortgages and those securities. But when you aggregate that behavior to the institutional level or the industry level, what you get is a very, very dysfunctional industry. Over the course of time, we move from what we call a Main Street logic, where home ownership is something that people aspire to and are willing to save for, and there's a very direct relationship between the home mortgage borrower and the lender. So the bank and the individual have a personal relationship. So the goal of mortgage lending under that regime is to help people buy houses. Over time, because of regulatory change and changes in the way that banks do business, we get what we call a Wall Street logic. So instead of talking to your banker on the main street of your small town, you're now working with a banker in New York City, even though you live in California, or often in Orange County, even though you live in Kansas. And the logic by which that relationship is governed is completely different. So instead of worrying about can this person afford this mortgage and afford this house, we see decisions being made based on how much money the lender can make from the loan on the back end. Instead of thinking about home buying as a process through which you establish some kind of security and permanence for your household, it's now an investment, and it looks like every other investment, and that makes it a transaction rather than a relationship. Part of the problem in this field is that the whole process was driven by innovation. So banking industry is a really innovative industry in general. People are always looking for new ways to make money, new kinds of securities to put together. Because that innovation is so successful in general, or at least a lot of the innovations are so successful, you get this herd behavior phenomenon. So one bank sees an innovation working and making money for another bank, and that bank, the second bank then decides we need to get in on this too. Seeking that profit for the individual banker or the individual bank is highly rational, and seeking it at the national level or the global level becomes highly irrational, because the more you borrow and the more you securitize and the more you seek those profits, the looser and looser the lending standards become and the more difficulty you run into, which is exactly what we saw. And the real problem is that there's no kind of guiding culture at the institutional level. It's difficult to regulate that out front, to get in front of that process. But what's less difficult is to prevent the kind of relationship from forming between the regulators and the banks that inhibits rational behavior. So in the case of mortgage lending and the banks and lenders that were in this space, they were able to shop around for regulation. The Office of Thrift Supervision actually advertised itself as being the loosest regulator, and saw the banks that it was regulating and the lenders that it was regulating not as objects to be regulated, but clients. And that's a really dangerous kind of relationship. Another thing that we saw was a really quick revolving door between Wall Street and Washington. So the bankers were being regulated by people that they knew, people that used to be the chairman of their bank. Another problem with that, though, is that there's a big knowledge differential between the regulators and the bankers. And especially when the bankers come up with these innovative products, it's hard for regulators to keep up. The story that we tell in this paper is idiosyncratic to the financial services industry and certainly very idiosyncratic to the mortgage crisis, but the general principles are absolutely generalizable to lots of different industries and lots of different scenarios. Unfortunately, it's difficult to identify those in advance, right? This is the kind of research that explains rather than predicts. But by explaining, what we hope to do is to kind of increase people's awareness, give them the tools to become more vigilant and identify potential problems earlier on.